Hello everyone, this is Crypto BitLaw here with another blockchain legal brief, and today we're going to discuss how the FDIC, the Federal Deposit Insurance Corporation, recently requested that all banks report crypto activity to the FDIC. So before we go on, please, if you enjoy this content, hit that like button and subscribe to our channel, and with that said, let's jump right in and see what this is all about. Alright, so here we can see CoinDesk reports that the FDIC asks all banks to report crypto activities. All FDIC supervised institutions have been asked to provide the federal banking regulator with information about their, quote, crypto-related activities. They say a top U.S. banking regulator has asked banks to report on their crypto-related activities, citing potential, quote, safety and soundness risks, as well as financial stability concerns resulting from exposure to crypto assets. On Thursday, the Federal Deposit Insurance Corporation, or FDIC, issued a financial institution letter, a letter sent to CEOs of FDIC-insured banks, requesting that banks should notify their regional FDIC director of their crypto activities. This request applies to both current and future crypto-related activities. According to the letter, the FDIC will review the information, ask more questions if necessary, and then issue relevant supervisory feedback. The new reporting requirements are a step up from previous FDIC statements on crypto. Under Acting Chair Martin Grunberg, the banking regulator has issued warnings about the potential for the rapid introduction of digital assets products into the financial system to pose systemic risks. In February, Grunberg said the FDIC and other regulators need to provide robust guidance to the banking industry on how to manage the risks posed by crypto. Thursday's letter is a signal that the banking regulator is now getting serious about cracking down on crypto. Because the vast majority of banks, including every national bank in the United States, are FDIC insured, the new requirements mean that nearly all banks with crypto exposure, including Wall Street titans like Bank of America and Goldman Sachs, must now disclose their crypto activities to the regulator. The FDIC isn't the only banking regulator turning its eye toward crypto-related banking activity. Last month, Office of the Comptroller of Currency, or OCC head, Michael Hsu, warned banks that trading crypto derivatives could result in extra regulatory scrutiny. Well, what we have here is just another example of this long path towards more government intrusion and surveillance as to what's going on with pretty much everyone's everyday lives, whether it comes in the form of banking, trading, investing, so on and so forth. If a bank is involved in crypto-related activities, another branch of the government, whether through natural or fiat control, the FDIC in this particular case, they want to know about what's going on. They want more insight into private entities' activity, what's going on in the private sector. And I think they're doing this for multiple reasons. I think in part it's due to the fact that they want to keep tabs on the KYC, AML sort of side of things, that has to deal with, counterterrorism funding and that whole, bucket of goods. But on the other side, they just want to know what's going on with this crypto, I guess in part because this entity is tasked with ensuring these banks and the people that deposit at these banks, as I'm sure most of you know, when you deposit with an FDIC-insured bank, your banking deposits at that bank are insured for up to $250,000 through the FDIC. And that was established due in large part to prevent a bank run where everybody just withdraws their money all at once and then the bank is left insolvent and you can't, anybody that's left with their money in there is just left holding the bag. And so I guess I could see in some aspects how they would want to know about the activity that's going on in these banks as it pertains to crypto, because at this point there isn't really much of a regulatory framework to go off of. And so I feel like it makes natural sense that they would want to know what sort of exposure a lot of these banks have to these products if they're going to be the ones left flipping the bill in the event of some sort of run that happens. So I'm in a mixed bag on this. And on one hand, I don't like Big Brother, knowing more than he needs to know about the everyday going-ons of what goes on in my life. But on the other hand, I think that it's also good to protect otherwise unknowing consumers from any sort of bank run or nefarious activity that could happen that they would just otherwise be unaware of just because some bank overexposes themselves on crypto derivatives. or it just takes out too much leverage. So it is what it is. I think it's just this natural progression of this constant evolution towards more transparency and regulation in the industry. Surely we'll be seeing more and more of this, but it's just really, it's interesting to think that, I mean, who would have thought? Here we are, in 2022, and we have all of these big name politicians and agencies really focusing like a laser on crypto, between the Biden executive order, the Treasury Secretary giving a speech on it yesterday, the FDIC coming out and wanting to know more, senators passing bills to regulate this industry. It's just really, it's a hot topic nowadays, and it's just crazy to think how far we've come in crypto and digital assets in general. So with that said, I hope you guys enjoyed this content. Please, if you did, hit that like button and subscribe to our channel. We'd appreciate that. And with that said, thanks again for watching, and we'll see you all in the next video.